As of the closing bell on Friday, November 28th, SoFi Technologies Inc. SoFi is trading at exactly $29.72 per share, having posted a robust daily gain of 4.32% or $1.23, with after-hours volume holding steady at that exact $29.72 level. To the casual observer scanning their Fidelity mobile app or checking the top movers on the Robinhood app, this move might look like just another strong day in a bull market. However, the expectation for SoFi has long been that it would hit a ceiling around the $20 mark, a psychological barrier where many believe the valuation would detach from reality. The reality, as we close out November 2025, is that SoFi has not only shattered that ceiling, but is now consolidating just pennies below the critical $30 resistance level, a technical breakout point that could trigger a massive institutional repricing event. We're no longer looking at a speculative fintech trying to prove it can make money. We are looking at a GAAP profitable powerhouse that has just reported its 8th consecutive quarter of profitability, with net income surging to $139 million in Q3 alone. The tension here is palpable. Bears are arguing that a price-to-earnings ratio of 54 is unsustainable for a bank, while bulls are arguing that SoFi is not a bank. It is the AWS of Fintech disguised as a consumer super app. To understand why this $29.72 price point is the most important level in the stock's history, we have to look at the immediate catalyst that is driving this volume. It isn't just the earnings beat from late October, it is the aggressive and frankly unexpected pivot into the crypto supercycle that CEO Anthony Noto announced earlier this month. The launch of full-scale crypto trading on the SoFi platform, making SoFi the first nationally chartered bank to fully embrace digital asset trading at this scale, has fundamentally altered the risk-reward profile of the stock. The expectation was that regulation would stifle this move. The reality is that by leveraging their bank charter and compliance framework, SoFi has effectively built a walled garden for crypto that appeals to the mass affluent demographic, the exact customers who are too scared to use an offshore exchange but are desperate to get exposure to Bitcoin and Ethereum. This move has triggered a wave of new account openings that is showing up in the user growth metrics, with membership now swelling to 12.6 million, a figure that would have seemed impossible just 3 years ago. The intraday action on Friday reflected this new enthusiasm. We saw a consistent bid throughout the session, with volume exceeding 26 million shares. This wasn't a gap and trap where the stock opens high and fades. It was a sustained accumulation campaign. For those using Interactive Brokers trading platforms to track order flow, you likely noticed large block orders hitting the tape at the $29.50 level, absorbing any selling pressure from profit takers. This indicates that institutional funds, perhaps those managing Fidelity mutual funds or large Schwab intelligent portfolios, are positioning themselves for a break above $30. If the stock clears $30 with conviction, the next major technical resistance doesn't appear until the all-time highs near $33 to $35. The golden cross on the weekly chart has already confirmed a long-term bullish trend, but the daily chart is where the battle is being fought right now. The RSI Relative Strength Index is hovering in the high 60s, suggesting strong momentum without being dangerously overbought. This is the Goldilocks zone for a breakout trader. However, the contrarian take that we must explore involves the valuation multiple. Trading over 50 times earnings is rich even for a growth stock. The expectation is that this multiple will compress as growth slows, but the reality revealed in the Q3 report is that growth is actually accelerating in the most profitable segments. The financial services and technology platform segments grew combined revenue by 57% year over year. This is the magic metric that justifies the premium. Unlike a traditional bank that relies on net interest margin, which fluctuates with Fed rates, SoFi is building a fee-based recurring revenue machine. The tech platform, comprising Galileo and Technisys, is no longer just serving small fintech startups. The recent announcement of the partnership with Southwest Airlines to launch a rewards debit card is a watershed moment. It proves that Galileo can win contracts with Fortune 500 non-financial brands. This expands their total addressable market, TAM, from other banks to literally any company with customers. If you are engaging in online investment or using SoFi investing tools, you need to understand that you are owning a piece of the infrastructure that powers the embedded finance economy, not just a student loan refi shop. Let's go deeper into the business model, specifically the financial productivity loop that management talks about endlessly. For years, this sounded like corporate buzzword salad, but looking at the 2025 data, we can see it working in the numbers. When a user joins SoFi to trade crypto or get a loan, they are cross-bought into a checking account, SoFi Money, or an investment account, SoFi Invest, at a rate of nearly 40% within the first 30 days. This drives the customer acquisition cost down and the lifetime value up. In Q3 2025, deposit growth surged by $3.4 billion to reach nearly $33 billion. Why does this matter? Because deposits are the cheapest form of funding. While competitors like Upstart or Affirm have to go to the capital markets and pay 6% or 7% to borrow money to lend out, SoFi pays its members 4% APY on savings and lends that money out at 12 or 15%. This spread is the bank charter advantage. It's a structural moat that is almost impossible for a non-bank fintech to replicate. The expectation was that the high interest rate environment of 2023 and 2024 would crush their margins. The reality is that their high-quality deposit base allowed them to expand margins while others were contracting. The technology platform segment, often ignored by retail investors using the Robinhood app, is the hidden gem that could eventually be spun off for a massive valuation. Galileo accounts dropped slightly to 157.9 million due to some churn of smaller, lower-quality clients, but revenue rose 12%. This signals quality over quantity. They are shedding the unprofitable neobanks and signing massive enterprise clients like the aforementioned Southwest Airlines and the U.S. Treasury's Direct Express program. This shift to enterprise sales creates sticky revenue. Once an airline or a government agency integrates your API for their payments, they are not switching next year. It's a 10-year lock-in. For an investor using a Fidelity brokerage account to analyze long-term holds, this kind of moat is what you look for in a compounder. Now let's address the macroeconomic backdrop of late 2025. The Fed has stabilized rates, and we are seeing a normalization of the yield curve. This is the perfect environment for SoFi. A stable rate environment allows them to aggressively price their personal loans and student loan refinancings without fear of sudden duration risk. Furthermore, the housing market has begun to thaw, leading to a 57% year-over-year jump in loan originations, particularly in the home loan segment. The expectation was that SoFi was purely a student loan story. The reality is that student loans are now a minority of their book. They have successfully diversified into mortgages, personal loans, and credit cards. The launch of the SoFi Smart Card, which offers 5% cashback and credit-building features, is a direct shot at the legacy credit card issuers like Capital One and American Express. By using their data advantage, knowing exactly how much money a user makes and spends, they can underwrite credit risk better than a blind issuer. Risks, however, remain elevated. The crypto bet is a double-edged sword. While it drives engagement and fee revenue now, any regulatory crackdown or a collapse in Bitcoin prices could lead to a swift de-rating of the stock. We saw this with Robinhood stock trading during the last crypto winter. When the tokens crash, the trading volume evaporates and the stock tanks. SoFi is now tethering its beta to the crypto market more than ever. Additionally, the credit quality of their borrower base is pristine, average FICO over 750, but if the economy enters a hard recession in 2026, even prime borrowers can default. The provision for credit losses has ticked up slightly, which is prudent, but it is a line item that needs to be watched like a hawk by anyone engaging in self-investing in this name. There is also the key man risk. Anthony Noto is arguably the most important CEO in fintech. His background as CFO of the NFL and COO of Twitter gives him a unique blend of financial discipline and consumer product instinct. If he were to leave, the premium on the stock would likely collapse overnight. He is the architect of the one-stop-shop vision. The execution we are seeing in 2025 is the result of decisions he made in 2018. Investors are betting on the jockey as much as the horse. Let's look at the future outlook through the lens of scenarios. Scenario A, the super app dominance. SoFi continues to grow members at 30% annually, reaching 20 million members by 2027. The Galileo platform becomes the standard for all non-bank embedded finance, retailers, airlines, logistics. The stock breaks $30, then $40, and eventually challenges the market caps of legacy players like Charles Schwab or PayPal. In this world, the PE multiple stays high because growth justifies it. Scenario B, the stagnation. The law of large numbers kicks in. Member growth slows to single digits. The big banks like JPM or BOA finally catch up with their own digital offerings, eroding SoFi's user experience advantage. The crypto market cools off. The stock gets stuck in the $20 to $25 range, trading like a traditional bank at 10 times earnings rather than a tech company at 50 times earnings. Scenario C, the acquisition. This is less likely now given their size, $36 billion market cap, but a massive legacy bank struggling with digital transformation